Are you super sure? Okay. You should be seeing my screen now.
I do.
All right.
All right, so it's still just you and me, but I'm gonna go ahead and press the start broadcast part and start acting like we're waiting for people, like waiting for those last couple of people to show up.
Okay.
Out of the hundreds and hundreds. All right, I am pressing start now.
That does not include me, I presume. The listen only mode.
Correct.
Okay.
Yep.
Just checking. Working out those bugs.
Yep. Hey everybody! For those of you that are online and waiting to start, this is Sean Gillespie talking. We're going to start in just a couple of minutes. Give folks a few more minutes to pop in real quick, but we are going to respect your time. For those of you that are here on time, we'll go ahead and fire up in about 2 minutes. Thanks. In the meantime, there will be no cool hold music.
Right. You should have cool hold music.
I could hum "Girl from Ipanema" softly.
Hey, we had intended to make the slides available to people, and I see now that we have forgotten to do that. Can we do that for the playback version, for the recorded version?
Yeah, no, we'll do that manually. We've got everybody's email addresses, so we'll send that out as part of the follow-up.
Send it out to the people attending here, but I'm wondering if we can hang it on the recorded version later. I don't know that answer.
Yeah, I don't think so. I think it requires manual intervention for us to send stuff out.
Yeah, we can do that. Okay, so.
Yeah, I think let her rip whenever you're ready.
Okay. All right. We will get started now. My name is Paul Allen. I am a founding partner and managing member at Redeployment Wealth Strategies. The other founding partner and managing member is Sean Gillespie. He is also here today. He is in a mostly non-speaking role, but he'll be active in the chat room. So if you have questions, you can type them in there. And then when he sees something that requires or merits interrupting me, he will do that. Otherwise, we'll just take questions at the end. So I have run this through. It takes about 45 minutes for me to go through the slides I want to go through. That gives us time at the end to get any questions in. And I know from personal experience that if you're not a tax professional and you're here, then you probably have a tax question you're hoping to get answered. Otherwise, you would not subject yourself to a tax lecture. And so if I don't answer, if the presentation doesn't answer the question, then feel free to ask it at the end. That will be fine. All right, without further ado, let's get started. We're going to talk about the tax law changes that are in place now for 2018. Actually, a couple of small parts of it are not going to take effect till later, and a couple of small parts of it took effect in 2017, but mostly it's tax law changes for 2018. Their impacts and opportunities is what we're going to talk about. And there it is. Sorry, my slides were slow to respond. So that's the agenda for the day. It's kind of long, as my shocked man there is shocked at that long list of things we're going to try and cover in 45 minutes, but trust me, we're going to get through it all and have some time to spare, I think. I don't have to read that list to you. There were a lot of tax law changes in 2018. It was a fairly significant overhaul of the tax system, and we want to make sure that people are prepared for it. All right, what is a financial planning presentation without some good disclaimers to start the day? So our lawyers and our regulators appreciate the fact that we're about to tell you these things. There are four disclaimers I'm going to get through as fast as possible. First one, Redeployment Wealth Strategies is licensed by the Commonwealth of Virginia to provide financial advice. However, licensing by Virginia does not constitute an endorsement of our knowledge or skills by the Commonwealth. Paul, that's me, is licensed by the Department of the Treasury as an enrolled agent to provide tax advice and taxpayer representation at all levels of the IRS, including appeals. This does not constitute an endorsement of me by the Department of the Treasury. And I would like to point out that while I am licensed to provide tax advice, This presentation is not tax advice. This presentation is for information purposes only. All facts and circumstances are different and unique to each situation. You should consult a qualified tax professional prior to using any information you hear today on your own tax situation. And finally, this is my favorite. You could come bring this up when you talk to Sean and I, because we had fun with this one. But Redeployment Wealth Strategies uses PIM Tax Services, LLC, for clients who elect to have us prepare their taxes. The reason we find that amusing is that PIM Tax Services, LLC is also me and Sean, or Sean and I. So the fact that the regulator forces us to point this out amuses us. Anyway, Redeployment Wealth Strategies clients are not required to use PIM Tax Services for tax preparation in order to engage Redeployment Wealth Strategies for financial planning services or advice. That was 2 minutes of my life we'll never get back, right? All right, moving on. I want to talk about transparency because it's our thing. When Sean and I founded this firm, one of the core principles that we hold is that we want to be completely transparent about everything we do. We don't like, something we don't like about our profession is that many people within it are not transparent. We want to be very different. So in that vein, let me point out the following things that you might already know. Redeployment Wealth Strategies is hosting this webinar to call attention to our services. You are being marketed to. That's probably no surprise. However, you are under no obligation to buy anything or provide us any additional information. We don't need you to do anything else except sit back and enjoy the free information we're about to provide you. However, at the end of this webinar, I will announce a special offer for those who make it through to the end. So you might want to stick around just to hear that. Plus, the information is going to be outrageously good. Okay, let's get into the meat of this thing. And when Sean and I were discussing the format of this, you know, he pointed out that not everyone is a tax weenie like I am, and I'm going to throw out a bunch of terms and expressions that most people don't use every day. So it would be helpful up front to go over the tax process and use that as a method to introduce some of the terms that are going to come up later. So without further ado, here's an overview of how a tax return is prepared. Excuse me. The first thing we do is gather your income from all sources. This is your gross income. And when we say all sources, we mean all sources. The IRS defines income very simply. It's everything that you took in during the year unless it is specifically excluded. So it's by default, everything, any increase to your net worth that you had was income to you unless it's specifically included under the code. All right, then we take adjustments to income. And adjustments is simply a fancy expression for a separate set of deductions that you can use even if you use the standard deduction. So for example, student loan interest, IRA contribution deduction, moving expenses can be deducted. Even if you don't itemize your deductions, you use the standard deduction. And we'll talk about those terms in a minute. But these are just simply bonus deductions, if you will, that you can take. Well, when you take the adjustments to your gross income, you end up with your adjusted gross income. Then we are going to subtract from your adjusted gross income your personal deduction or your individual deduction, which is either standard or itemized. And we'll talk about that some more later in this presentation. You can also subtract from your adjusted gross income personal exemptions, and these are things that we are. So each person on the tax return qualifies for a personal exemption, or at least they did in the past. And exemptions and deductions reduce your income. It reduces the amount of income that's exposed to taxation, because when we take your adjusted gross income and we subtract out your deductions and your personal exemptions, what's left is your taxable income. And that is what we apply a very complicated tax formula to figure out what your tax is on your taxable income. All right, that's why I bounced that in to highlight the fact that it's prepared, or the way that your actual tax is calculated on your taxable income can be a long and arduous thing depending on the sources of your income. Once we know your tax, we're not done. We apply tax credits at that point, and we subtract tax credits from your tax in order to reduce your tax to what we then refer to as your total tax. So these are the terms we're going to use throughout: income, adjustments, deductions, exemptions, taxes, and credits. And that's how they come to be on Form 1040. So speaking of Form 1040, let's talk about changes in 2018. The tax form itself has changed, and this is going to be largely invisible to, I think, most people, because almost no one uses a paper form anymore. Everyone files electronically. You're like 90% plus of people file electronically, and they don't see these forms. But if you recall, a few years ago, there were some political promises made that the tax return would become the size of a postcard. Well, apparently what that means is half a page, because the new Form 1040 is now half a page front and back, which to me sounds like a page, but it's postcard size, half a page front and back. And it's in draft format there. You can see the version I have has a watermark on the back indicating that it is a draft. And it is half a page long. The front of it looks like this. It will have your personal information, list of dependents, etc. It looks very similar to the top of the old Form 1040, but now we're going to sign the front of the form. That's where they decided to move the signature blocks up to the front. So the front page of Form 1040 has half a page and contains personal information and your signatures. The back contains actual tax information on your income and your taxes and your deductions, etc. So the tax form is essentially, the 1040 is essentially half as long as it was. Do not confuse this with meaning that it's shorter because the tax laws are simpler. That is simply not the case, because all the information that was removed from this form to make it postcard size was put on these 6 new schedules. So these are new tax forms for 2018, and they are schedules 1 through 6. Schedule 6 will probably never be used by me this year, but schedules 1 through 5 will be used quite often, because they are where all the information migrated to that came off the Form 1040 to make it shorter. And if we go back to page 2 of the 1040, and I blew it up a little bit here to make it hopefully easier to see, and boxed in where it says on line 6, include the amount from Schedule 1, include the amount from Schedule 2 on line 11, on line 12, include the amount from Schedule 3, etc. So what we'll do now is essentially what this did is make the tax return more difficult to read, because you'll have to be shuffling back and forth between pages to figure out where the information came from. But it is a smaller form. All right, let's move on to changes in the tax rates. All right, tax professionals or tax people use the term top marginal rate, and that is the highest rate at which you pay income tax. And this graphic, a little bit of an eye wash, but what I've done is on the right side, the right column, is the 2017 tax brackets for married filing jointly people. So MFJ is tax weenie shorthand for married filing jointly. So these are the tax rates for married filing jointly people, and I'm comparing 2017 to 2018, and I'm only using the bottom 5 rates, or the bottom 5 brackets. There are still 7 tax brackets. There were 7 in 2017. There are 7 in 2018. They are just different. And if we take a look across here, now if you're married and filing jointly and you have $100,000 in taxable income, well, last year your top marginal rate was 25%. Some of your income at the top rate was taxed at 25%. This year it would only be taxed at 22%. And then you had income below that level that was taxed at 15% last year that will only be taxed at 12% this year. And the actual size of the brackets has also been adjusted. So you'll see some tax savings based on tax brackets. These new tax brackets will tend to decrease your taxes. Even at $100,000, at $300,000, they will decrease your taxes pretty significantly, because last year you would have been at a top marginal rate of 33%. This year your top marginal rate would only be 24%. That right there would save this couple $27,000 in taxes, excuse me. So the new tax rates are going to drive the amount of income taxes that are owed down. Next, we'll talk about personal exemptions. And in 2017, each person listed on your tax return got a personal exemption for $4,050. And this is, again, removed from your income so that you didn't pay tax on $4,050 times each person on the tax return. Well, in 2018, personal exemptions are suspended, and they're suspended until 2025. So the tax law changes were not made permanent. They were made for 7 years, at which time the Congress will have to vote on them again. But in 2017, there were personal exemptions. In 2018, there are not personal exemptions, and this will tend to increase taxes because then this was money that was removed from taxes from your taxable income in 2017. In 2018, it will be included in your personal income. So a little bit of a balancing act there between the lower brackets, but now no loss of personal exemptions. And then the third large change was with the individual deduction or the personal deduction on Form 1040. And I want to talk about the fact that you can take the standard deduction or you can itemize your deductions. And I don't know why, but I really like little skeptical fellow here. He's not having it. He's not buying it. But I guarantee you or I assure you everything I'm saying here is true. All right, your personal deduction is an amount of money that is not subject to federal income taxes. So again, we're removing that from income. So it's income that you had, and then we're taking it away and saying we're not going to charge you tax on that. So the federal government is saying. All right, so you can itemize or you can use the standard deduction every year, and either is legal. Excuse me. In any given year, you can do one or the other. And so in any given year, you will select the one that is most advantageous for you, and you can do that. It doesn't have to be uniform year over year. So if last year you itemized, and that was more advantageous, you can use the standard deduction this year if it's more advantageous. And that is likely to be the case. Excuse me. I woke up with a scratchy throat this morning. I thought, oh, great, today's webinar day. All right, here are the standard deductions for 2018. And as you can see, there were big increases. This is the big increase in standard deductions is probably the main reason why most people will use the standard deduction in 2018. Not everyone, but most people will use the standard deduction because they're listed there in the center column. Single people will get a $12,000 standard deduction, married and finally joint couples will get a $24,000 standard deduction. You see the 2017 values in the far right column next to it. They've almost doubled, quite a bit larger than they were last year, and this will tend to decrease your taxes. So we've had, the brackets tend to decrease, the increased standard deduction tend to decrease, somewhat offset by the fact that the lost personal exemptions. So, but let's look at an example and see the net effect of those three changes. On a single fellow, we'll call him Tommy. Tommy is filing singly, and he has $50,000 in annual salary. In 2017, that's the table that's showed now, he took his standard deduction of $6,350 and his personal exemption for $4,050, and he had a taxable income of $39,600. And on that, he would pay a tax of $5,554. 2018, with the same salary, he takes his standard deduction now of $12,000. There is no personal exemption in 2018, so his taxable income is now $38,000. That's slightly lower, and when you combine that with the now lower tax rates as well, he's going to save almost $1,200. Tommy is in taxes between 2017 and 2018. His tax bill is going down. His federal income tax bill is going down in 2018 from the prior year. Now, another reason that most people will use the standard deduction in 2018 is because itemizing your deductions got worse. It's harder to make itemized better than standard for two reasons. Standard grew and itemized deductions shrunk. You can still get there, and some clients will, but it's kind of the double whammy. Let's look at the things that influenced itemized deductions. Well, the first is that state and local taxes are now limited, and those are your state income taxes, like your Virginia income taxes if you're filing in Virginia, your real estate taxes on your personal residence, personal property taxes on things that, like in Virginia Beach, they hit you with a car tax and a trailer tax and a ski-doo tax, etc. So your state real estate and personal property taxes used to be deductible on your federal income tax return in any amount. Whatever they added up to, you could deduct the whole lot. Well, starting in 2018, the maximum federal deduction for those is capped at $10,000. So you can no longer deduct more than $10,000 off your federal income tax return for your state and local taxes. Mortgage interest also got slightly worse as a deduction. It used to be that you could deduct interest on loans mortgage loans on your personal residence up to $1 million. As of December 15th, loans originated after that date, now you can only deduct interest up to $750,000. That's not going to affect that many people. That's a very significant loan still, right? So not a lot of people own houses in that range. But the second part is the home equity loan interest, and that will affect quite a few more people, because prior to 2018, you could take a home equity loan on your personal residence and use that money for whatever you wanted. You could pay off your student loans, or you could buy a boat or take a trip to Europe or whatever you wanted to do, and you could deduct the interest on that because your personal residence was used to secure that loan. That is no longer true. You can now only deduct that money as a personal deduction if it was used to make improvements to your primary residence. Now, you can borrow money. I get this question frequently. You can borrow money against your house. You can take a home equity loan out on your house and start a business and deduct that interest then, but that is deducting it as a business expense. So I'm talking about if you want to deduct it as a personal expense, it has to be used to improve the home. Miscellaneous itemized deductions are suspended. So the biggest issue in that category was unreimbursed expenses of employees. I have several people who are going to suffer because of the fact that this has gone away. So some people have to spend money to have their job. A big category in that regard is auto mechanics. They are frequently required to bring their own tools to the job, and so the employer does not reimburse them for having their own tools, and so those were deductible as a business expense. An unreimbursed expense of being an employee, that whole category of expenses has gone away, so those are no longer deductible for people. So if you are spending money on your job that your employer is not reimbursing you for, and you have been deducting it from your tax return, that is no longer allowed starting in 2018. The exception to that rule was for military reservists. So military reservists can still deduct the cost of drilling, and but everybody else, that deduction is suspended. And then finally, in this category, we'll talk about casualty and theft losses. Used to be that if you experience a casualty or theft loss and it was not covered by insurance, you could deduct it from your taxes. Now that is only true if it happens in a federal disaster area. So vandalism to your car, and that's uninsured, no longer deductible on your taxes, for instance, unless it happened in a federal disaster area. All right. I want to talk about something. I'm calling it the Virginia effect because I've really only analyzed it for Virginia. I do, of course, the majority of tax returns I do are for the state of Virginia. This may or may not apply to your state if you pay income taxes to another state. However, it's something that you would want to look out for. Okay, and here's what happens. Virginia's tax form is very similar to the federal tax form. So you can take a standard deduction in Virginia, or you can itemize your deductions in Virginia. However, under Virginia law, you have to do it the same way you did it on your federal tax return. So if you took the standard deduction on your federal return, you have to take the Virginia standard deduction. If you itemized your deductions on your federal return, you have to take the federals, or the Virginia, you have to itemize your Virginia deductions, excuse me. Virginia's standard deduction did not increase in 2018, like the federal standard deduction nearly doubled. Virginia's did not. This leads to this strange situation where there's a fairly significant gap here, I think, in which in some cases it will be more advantageous to itemize deductions on your federal return, even if the standard deduction is more advantageous on your federal return. And you would want to do that so that you can itemize your Virginia return and end up with a better overall result. I know that's a mouthful. I'm going to show you an example here that I think makes it fairly clear. So this is example 2. It's Chucky and Angelica. They are married and filing jointly. They have $100,000 in combined W-2 income. When they want to itemize their deductions, here's what they can itemize. Their Virginia taxes withheld were $4,400. Their real estate taxes were $7,000. Their mortgage interest, $10,400, and they're made a nice charitable contribution of $3,400, and that all adds up to, oh, don't forget, those two are capped. The total there is capped at $10,000. So even though that adds up to $11,400, that's capped at $10,000. So the total under the new tax law math, the total of those 4 things is now $23,800. So if they itemize their federal return, they can itemize deductions for $23,800. $800. Well, that's less than their standard deduction, which would be $24,000 for a couple married filing jointly. So you would think, let's take the standard deduction. And here's what happens when you do. On your federal return, your tax rate or your tax bill would be $8,742. In Virginia, now you had to take the Virginia standard deduction because you used the federal standard deduction, and your tax bill in Virginia would be $5,041 for a total tax bill of $13,783. But if you itemize your deductions, yeah, your federal tax bill went up a little bit, but your Virginia tax bill, or in this case, Chucky and Angelica's Virginia tax bill, went down $4,190 to $4,190. Their total tax bill is $827 lower because they itemized instead of using the seemingly more advantageous standard deduction. I bring this up because I pay a lot of money for my tax software. I guarantee I pay more for my tax software than anyone listening pays for their tax software. And my tax software universally defaults to whatever gives you the best result on your federal tax return. And it doesn't care what happens to your Virginia tax return, but I do. So I have to go in there and override it. Okay, so if you're doing your own taxes and you're using a tax software that I'm sure is less robust than mine, it probably also defaults to whatever gives you the best result on your federal tax return, and that would cost you money. So I want to make sure people are aware of that. And if you're preparing your own tax return, make sure you force it to run it both ways with itemizing and standard deduction, and use the one that gives you the best overall result. Okay. All right, let's move on to child tax credits. I know at tax time, I see a lot of parents look very lovingly at their children because of the dramatic impact that having children can have on your tax, on the tax you owe. All right, and it just got better. So the tax credit for children, and these are children who are your dependents living in your home that are under the age of 17, used to get a $1,000 tax credit or qualify for a $1,000 tax credit. This year, they qualify for a $2,000 tax credit per child. And that is significant, but not as significant, I think, as this part, which is that the phase out threshold increase. So look at the second line there, the married filing joint line. It used to be that a married filing joint couple would start to lose their child tax credits at $110,000. They would start to phase out. That now is $400,000. Well, I had a lot of married clients, two income families whose taxable income, or excuse me, the adjusted gross income was above $110,000. A lot of clients were not getting child tax credit. Now they will, because I don't have very many whose combined income is over $400,000. All right, let's take a quick look at another Chucky and Angelica scenario. They are, in this case, married filing jointly with two children who qualify for the child tax credit, and they have $150,000 in combined annual salary. So let's look at in 2017 what their tax bill was. They had $150,000. They took the standard deduction and 4 personal exemptions. Those were great. So that their taxable income came all the way down to $121,100. The tax on that was $20,631. They had too much money, too much income to qualify for the child tax credit, right? The phase out started in 2017 for married filing jointly. It started at $110,000. In the case of Chucky and Angelica, they were completely phased out and got no child tax credit. So their final tax bill was $20,631. Let's look at them, same couple in 2018, same income, standard deduction, $24,000, no personal exemptions. So their taxable income's a little bit higher. That's kind of a bummer, but because of the lower overall tax rates, even though their taxable income is higher, the calculated tax on that amount is lower than it was in 2017. Additionally, in 2018, they will qualify, both children, for full $2,000 apiece child tax credits. So that comes straight off their tax bill. Their final tax bill is more than $7,000 lower than it was in 2017. I'm going to have a lot of happy families in my office this tax season. Families with children are doing very well under the new tax laws. Unless they've got some other mitigating circumstances, generally they will do quite well. Okay, let's talk about this new thing called credit for other dependents. And this other dependent is your brother-in-law, and he lives in your basement, and he's a filmmaker or something. We don't know. But he spends a lot of time on a couch, and he now qualifies because he's on your tax return as a dependent for this new $500 credit. And it's for dependents who do not qualify for the child tax credit. And while I make jokes about lazy brother-in-law and filmmakers, etc., in reality, this is mostly for people who have children above the age of 16, so they don't get the child tax credit, but who are still on the tax return. So, high school juniors, seniors, and college students who are still on your tax return. You lost the personal exemption for them, right? So now you're going to get this $500 credit for each of them. So there's some offset there. And the phase out threshold for this is the same. I'm sorry, it's the same as it was, right, for the child tax credit. 400,000 for a couple that's married and filing jointly. Okay, let's move on to this thing called the qualifying business income deduction. I'm pretty sure I didn't actually keep track, but I'm very confident when I say that I have spent more time studying this aspect of the new law than everything else combined, because it is brand new. Everything else is a modification. The child tax credit was modified. This qualified business income deduction, or Section 199A deduction, is completely new. And so it's strange. And I'll tell you what I've learned so far is that it's highly complex. It is highly valuable, and there are still some unknowns. And most of the unknowns that I have are not about the technicals or the mechanics of it. I know how to calculate it. It's integrating it into an overall tax strategy, and I'll give you an example of that here in a few minutes so that you can kind of see the added complexity of this. But what it is a 20% deduction on qualifying business income. So what is qualifying business income? It's income from a pass-through entity, such as a home business, a partnership, or an S corporation. So a pass-through entity is an entity that it might file its own tax return, but it doesn't pay its own taxes. The income and expenses ultimately flow through to your personal tax return, and the taxes are paid as part of your individual tax return. Okay. Also included is qualifying business income is income from REITs, real estate investment trusts, which are a form of real estate investing, and also publicly traded partnerships. And I want to point out that the 20% deduction on qualifying business income is also limited by what I'm calling pre-qualified business income deduction income. And there'll be examples where you can see what I mean by that here in a minute. Okay, let's look at an example. Susie is single and has $50,000 of annual income from her home business. And for purposes of this example, I am disregarding self-employment taxes. There are some home businesses that, where you're not required to pay self-employment taxes. So we're just going to say that she has one so that it makes the example easier to follow. Okay, so in 2017, Susie had $50,000 of income from her home business. She took the standard deduction, personal exemption. Her taxable income was $39,600, and her tax was $55,54. In 2018, she does nothing. The tax laws changed around her. She again has $50,000 in taxable income. Her standard deduction is $12,000. She gives a pre-qualified business income deduction taxable income of $38,000. So this is where that limitation comes in. So the limitation is now 20% of pre-QBID taxable income. So her qualified business income deduction is $7,600, which is 30% of $38,000. Excuse me, 20% of $38,000. That makes her taxable income $30,400, and her tax bill is now $34,558. Without doing anything, Susie's saving more than $2,000, almost 35% of her tax bill, because her income is from qualifying business income. This is a law designed to make us all want to start our own businesses because the tax rates are so favorable for you to do so now. Let's look at another example of that and compare Susie with Tommy. Susie's income is same as from the previous page. She's got qualifying business income, and Tommy is an employee who is paid with a W-2. They both make $50,000. Tommy in 2018 is going to pay $4,370 in taxes. Susie, same income but different source, qualifying business income, is going to pay more than $900 less in taxes than someone who makes the same amount of income by having a job as an employee. Okay, question I get frequently because I have a lot of real estate investors as clients is, will my rental properties qualify as qualifying business income? And let me tell you briefly where we're at on that. The IRS promised us guidance, and they've issued what is known as interim guidance, and I've read it. It's 88 pages long, and I will tell you that it is not clear. So what the IRS did, they punted. All right, I don't mean to point a finger, but they really punted on this. So they said, hey, if the real estate investment income meets the Section 162 definition of a trade or business, then it qualifies. Well, joke's on us. Section 162 doesn't define what a trade or business is. That's been defined in case law. So we have to look through prior court cases from the tax court and see what the judges have said. Well, some judges have said, of course, all rental properties qualify as businesses, and some judges have said, well, it depends on some factors. Okay, so as long as you are active in the management of your rental business, if we are not giving any additional information, if you have me do your taxes, I will be filing them as qualifying pass-through business income. Okay, so bottom line is, unless the IRS comes up with final guidance, which I am not expecting, Treasury is infamous for not providing guidance in a timely fashion, I will be filing rental properties and taking the qualified business income deduction for my clients. All right, I told you the part that still is a little confusing to me is how to integrate QBID into strategies, and I'm going to do a quick example of how it influences the value of your traditional IRA contributions. So we're going to call this couple Stu and Dee Dee, and they have $124,000 of income, all from a qualifying business. Okay, so they take the standard deduction and they have a subtotal of $100,000. And then we would, if they had made IRA contributions, we would deduct it here, but they did not. So they end up with a pre-QBID taxable income of $100,000. Their qualified business income deduction is $20,000, and their taxable income is $80,000. Now, what happens if they actually make the traditional IRA contributions? All right, so we have the 124 minus 24 gives us our subtotal, and then they each gave $5,500 to their traditional IRA, so we can deduct $11,000. That gives a pre-QBID taxable income of $89,000. That limits our qualified business income deduction to $17,800, 20% of $89,000. And that makes our taxable income $71,200. Now, did they get a benefit from contributing to their traditional IRAs? They did, but they didn't get a normal benefit, because normally if you make an $11,000 contribution to your IRA, or you both make $5,500 contributions to your IRAs, you deduct the full $11,000. In this case, they only got an $8,800 deduction for putting $11,000 in. The QBID skewed the result. Okay, so when Sean and I are looking at, everybody's question, should I be doing a Roth IRA contribution or should I be using a traditional IRA contribution and taking the deductions? We want to look at the lifetime tax impacts of that. Well, the lifetime tax impacts of that change now if you have qualifying business income and are taking that qualifying business income deduction. So it's added a level of complexity that we have to model for. And again, this is why I say, do not try to take what you see here today and apply it as if it's tax advice, because we have to know the unique facts and circumstances of your situation in order to provide actual tax advice. All right, withholding rates changed. Anticipating that most people would have a lower tax bill for 2018, because most people will have a lower tax bill for 2018, the IRS also told employers, hey, here's new guidance on how to do withholding, and it decreased withholding. So you may have noticed back in March when this was implemented, you might have got a little bump in your take-home pay, and that's because the withholding rates changed, right? The amount of federal income tax withholding from your pay was changed, okay? And that, it's cool to get a bump in your take-home pay, but the potential problem is not everybody is actually going to have a lower income tax bill as a result, but everyone did have their withholding changed. So if you're not going to do better under the new tax law and yet your withholding went down, you might end up getting a big tax bill in April. And if you had significant under withholding, then you might have an underwithholding penalty, which we would want to avoid. And the way you avoid that is by adjusting your Form W-4. So you would have to go back to your employer and say, I would like you to withhold more. That's the adjustment we're talking about. You adjust it to increase withholding. And if you want help with that, contact us here and we will help step you through a projection on what your tax bill will be and whether or not your withholding is going to meet that so that you can avoid this underwithholding penalty. All right, let's look at an example of that. With again, we're going to use Stu and Dee Dee as the names. The names have been changed to protect the innocent because these are actual numbers from an actual client of mine, and that's why I have such precise numbers up there. So in this case, they're married and filing jointly, and they have $116,836 of AGI, and they have 3 children. And in 2017, those children were 16, 18, and 20. So the youngest, the 16-year-old, qualified for the child tax credit. In 2018, those children are 17, 19, and 20. None of them will qualify for the child tax credit, but they will all qualify for the other dependent credit. So let's look at a comparison between tax years. In 2017, again, they itemized their deductions, so they had $20,084 in itemized deductions. They took the personal exemptions, 5 personal exemptions at $4,050 each is at $20,250 exempted from income. That was pretty nice. So their taxable income was $76,502. The tax was $10,609, and they did get some of the child tax credit. If you recall, the 2017 phase out for child tax credit started at 110,000. So they were over that. They lost some of the child tax credit for the youngest one, but not all of it. So they got $650 child tax credit, and their total tax bill, federal tax bill, was $9,959. In 2018, they have the standard deduction for $24,000, and they lost all those personal exemptions. So their taxable income is $92,836, over $16,000 more taxable income. So even though the tax rates went down, when we figure the tax on so much more income, their tax bill is now $12,301. They take the 3 times $500 other dependent credits. We remove that $1,500, and their actual total tax bill comes to $10,801. So they're going to pay, what is that, $850 more in 2018 than they did in 2017. And yet their withholding went down. So they may be facing a big tax bill in April, and they may be facing penalties for under withholding. Again, if you have questions about whether your withholding is right for the new tax environment, then please give us a call here. All right, briefly going to touch on some of these other issues that I think will impact some of my clients. All right, moving expenses no longer deductible. It used to be if you moved more than 50 miles to take a new job, then your moving expenses were deductible. Not true anymore. Changes to the depreciation laws. If you're a business owner and you bought business equipment and you were taking depreciation expenses, those became more favorable to you in 2018. So you would want to know more about that. 1031 exchanges have changed. It used to be any like kind property could be 1031 exchange. Now only real property, real estate is the only type of property that qualifies for 1031 exchange. Alimony deductibility. If you pay alimony currently, it will not change. This is only for new, court decisions for alimony after January 1st of 2019. So this is not even in effect yet for this year. But currently, alimony that is paid is deductible from the payor, and it has to be paid taxes on it for the person who received it. Starting in 2019, no longer the case. The person who earned the income, even if they pay it out to someone else as alimony, they still have to pay the tax on it. It became easier to roll money from a 529 college savings plan to a 529 ABLE account. I am a big fan of the 529 plans. If you have any question about that, just ask me. The 529 ABLE accounts are for disabled persons who gives them an opportunity to save in a tax-deferred manner without jeopardizing their right to public services. And it became easier to roll money from a college savings plan into that. It's a fabulous new addition to the 529 laws. ACA penalties, Affordable Care Act penalties are gone. So it used to be that if you didn't have health care, it used to be for like 4 years, I think that was in effect. If you did not have health insurance, you were liable for a tax penalty, which we called the shared responsibility payment. So that didn't sound like a penalty, but it sure felt like a penalty to people who had to pay it. But those are gone. And there were changes to the alternative minimum tax. They were not drastic changes. It got a little better. That it was never indexed for inflation. If you were paying alternative minimum tax, it got a little better, but it's still going to be painful for you. And then finally, the estate tax exemption doubled. So if you are a high net worth person and you have a large estate that you want to transfer upon death, you can now exempt up to $11 million of that before estate taxes kick in. There are more changes. I'm not going to go over them or attempt to cover every single thing in a single hour. How about that? I do want to talk just briefly, my list of winners and losers under the new law. The winners, families with children under 17. I talked about that new child tax credit and the expanded availability of it and the expanded credit. It's fantastic. So those people are going to probably do the best, in my opinion. Small business owners are doing pretty well because of that qualifying business income deduction. And then I just went over on the previous slide most of these other things about about the benefits people are experiencing under the new laws. Losers, again, people who moved, right? Moving expenses not deductible. Employees with expenses no longer deductible. Taxpayers in states with high income tax rates. So California, New York, New Jersey residents not so thrilled about that $10,000 cap on the federal deductibility of state and local taxes, but it is what it is. High income families with children in college, again, because you get that $500 credit, but it doesn't really offset your loss of the personal exemption for that child that's in college. And then I'm just going to read this to you. If you know what it means, good. But it's real estate investors who did a cost segregation and now want to 1031 their property. If you know what all those mean because you did that, but you don't know why you're in a worse tax situation now than you were before, contact me before you do anything, because you'll want to know what's coming down the road for you. Okay, and as promised, here's a special offer. So when we take in new clients, as part of our fee structure, we have a $300 onboarding fee because that's where we do a lot of additional work for clients. And for participating in this webinar, for viewing this webinar, we are going to waive that for you. So if you would like to come in for an initial consultation appointment sometime in the next 6 months, that's what May 14th, 2019 means. And by the way, that initial consultation appointment, also free. So you could come in for that. And then and whenever you secured our services after that, then we would waive the $300 onboarding fee. So essentially, we just gave you $300 for watching this webinar. Unless you're already a client, I guess. I probably have some existing clients that are watching as well, just because they want the information on the new tax laws. Okay, so we'll wrap it up here. Just want to say that taxes are a significant part of financial planning for most people, right? When I was still on active duty with the Navy and the only financial plan I was looking at ever was my own, I spent an awful lot of time looking at taxes. So financial planning firms that do not integrate tax planning directly into financial planning baffle me, because to me, they're just inseparable. So I'm glad that we're all able to offer that here at Redeployment Wealth Strategies. And well, let me wrap that up. If there are questions, please ask them now. All right, hearing none.
So Paul, this is Sean here. I'm working on unmuting everybody so that anybody who has any questions can
we'll take this opportunity
can go ahead and chip in. Yeah.
Pour some tea. My throat is feeling that 45 minutes.
By all means, please, please do. Let me carry the ball for like 60 seconds. We do have a few folks on the line still, so I've got all the microphones, all the sound unmuted. So if anybody's got any questions, just go ahead and fire away. Apparently nothing.
All questions answered. It's remarkable. Or
Anybody out there?
people don't have microphones on their device that they're watching.
Yeah, that might be it. I'm looking at the chat too, and so far I don't see anything. When we ran the rehearsal on this, we had a fictitious Paul Walker, newly unemployed from Sheboygan, Wisconsin, dialing in with a question. But apparently this is apparently you're very thorough, Paul.
Or my email queue is filling up right now. And that's fine too, by the way. I don't mind taking questions in email because I can take my time in answering them, making sure that I do the appropriate research to ensure I've got the right answer.
Yeah. Well, all right. Hey, thanks everybody. Last piece for you on your control panel over on the little box probably on the right side of your screen. There's a little thing that says handouts. If you click on that arrow, it'll open up to a little download for a feedback sheet. If you have a few minutes and want to fill that in and send it back to us, we'd love to hear from you. And other than that, the offer that Paul ran through right at the end, that's obviously it's good for 6 months. So we'll look forward to hearing from you at y'all's convenience. Thank you.
Thank you.
Hey, sure thing, Chris. Are you good there? You got if you got any hot questions, we're going to be around for a few minutes, but otherwise, if you're ready to punch out whenever you're ready.
Yep, all good for now. Thank you, guys.
All right, have a good one. Thanks.
You too. Bye.